Jay Pelosky is founder and principal de TPY Advisory. Jay, thank you so much for having us a few minutes in Negocios TV.
Thank you, Marta. Always good to chat with you.
Jay, starting for Twitter, Elon Musk reached this Monday an agreement to acquire Twitter for $44 billion. How do you see this movement from the Tesla's CEO, and what does it mean for Twitter?
Yeah, I mean, I don't really have any insight, particularly into what it means for Twitter. I do think it's interesting. A lot of people are wondering what it means for Tesla, given that that's a big stock and an active stock where a lot of people are involved. And to me, the point is that Tesla has demonstrated over the last couple of months quite a deep bench in terms of ability to open state-of-the-art production platforms, not only in Germany, but also in Austin, Texas. So it has introduced 2 state-of-the-art production platforms on 2 continents in 1 month. And so clearly that's not solely due to Elon Musk. And so I think importantly, at least from Tesla point of view, he has plenty of expertise on the ground, and he has really put Tesla into a leadership position in the electric vehicle space, which I think is a much bigger business, certainly in the near term, than whatever will happen with Twitter.
Jay, special attention to Tesla's stock plunge. Why is Tesla falling so much? Which is the reason? We are seeing that there is a rising possibility that Musk could need to sell billions of dollars worth of Tesla shares to finance the remaining 21 billion of cash of the 44 billion takeover at all. What do you think?
Yeah, no, I think that's seems to be what people are concerned about. I mean, I noted in my recent writing, my weekly musings on Fridays, that Tesla reported first quarter earnings last Wednesday, and their numbers were fantastic. They blew away Wall Street estimates. They had fantastic earnings, way better than expected production. Again, demonstrated ability to maneuver through all the issues regarding semiconductor shortages, worries about mineral supplies for the electric vehicle batteries, right? Worries about cobalt, nickel, etc. Maneuvered through all of that phenomenally well. And so the stock was up 10%. And then, of course, we had Chairman Powell come out and talk about 50 basis point hike in May. And the stock really hasn't, like most of the market, really hasn't recovered. So that 10% gain post fantastic earnings and expectation of continued strong production growth throughout the year has been overtaken by external events. First, the Fed and worries about hikes in May next week. And then secondly, as you point out, concerns over the Twitter bid and I guess now purchase or soon to be purchased, and the potential for potentially significant amounts of Tesla stock being released onto the market.
This week, tech giants, between them, among them Twitter, Microsoft, Apple, Amazon will release its quarterly earnings. How are you seeing this sector? What do you expect from these quarterly results?
Well, we've been pretty negative on big cap tech for some time. My view has been since early last year that rising interest rates are kryptonite for big cap tech because they're long duration stocks and tend to be valued in part on the interest rate structure. So we've not been involved there really at all for well over a year, and continue to kind of stay away from it because it's so widely overowned and has been the leader for so long. I'm of the view that we are in very early stages of a leadership shift away from big cap tech and away from U.S. equity leadership towards much more towards value and cyclical shares for what I expect will be a better than what consensus expects global growth outlook over the next couple of years. And so when we think about technology at TPW Advisory, we're thinking more about the innovation space, the thematic space, the robotics, fintech, climate, those are the areas where we're taking kind of high growth risk with a view that that segment of the market has already had its bear market, right? I mean, if you think of things like ARK, that ETF peaked back in February of last year and has effectively done a complete round trip, not just in stock price, but also in terms of valuation. And now you have a situation where a lot of these leading smaller innovation companies are trading at a discount in the public markets to the private market valuation. And so you're starting to see M&A activity, and that's somewhat like what Elon Musk is doing with Twitter. We're seeing it in other spaces like in cyber, in other areas where the private market valuation is well above the public market valuation. And so we're seeing takeover bids because the public stock is cheap. And that, of course, provides an underpinning for that segment of the market. So to us, we're really looking for a better than expected kind of high nominal growth environment over the next several years around the world. And the way to play that, we think, is in the innovation and thematic space.
And finally, Jay, looking at central banks, next week all the attention will be on Federal Reserve, on the Fed's monetary policy meeting. 50 basic points hike is now on the table. How far can the Fed raise rates to contain inflation?
Yeah, no, I think it's more than on the table, Mata. I think it's pretty much a done deal at this point. I think people would be shocked if the Fed does not raise rates 50 basis points. And look, that's part of the Fed's action here. Part of their toolkit is is what's called traditionally jawboning the market, right? Speaking aggressively, letting the market take rates up higher. And we've seen that, right? A dramatic increase in interest rates from the 2-year to the 10-year. And then that's fed into the mortgage rate market, which is starting to have the effect of cooling the housing market in the U.S., which has been very strong. And so that is already happening. And I think what my view is right now is that the recent rally in the 10-year U.S. Treasury from 3%, we hit 3% last week. That was one of the causes for stocks to sell off so sharply on Thursday and Friday. Now that same 10-year is at 2.74%. And I think it's starting to sniff out the peak of inflation. So the Fed is on May 4th. The CPI for April comes out about 10 days later, the middle of May. And I believe it's going to show a reduction from the March inflation rate. And so I believe we're at the peak of this kind of fever, what I call a fever, of inflation concerns leading to expectations of higher rate hikes, leading the market to price in ever more rate hikes. I think we're now up to 14 rate hikes this cycle, to a Fed funds rate in July of over 2%, which means 50 basis points in May, 75 in June, and 50 basis points in July. That's what's already priced into the market. And I think we're not even going to get there, because over the next several months, inflation almost by default is going to fall in the U.S. due to base effects. I also think we've seen the peak in oil prices in the near term, used car prices, and other things that suggest that inflation, 8.5% in March in the U.S., could be trending towards 5% by the summer, and then gradually, hopefully, going down further. And so this idea that we need to have 14 rate hikes in the cycle by the Fed, I think is going to be proven to be incorrect, in part because we're already rolling over on inflation. And so that's what I think the 10-year is telling us. It tried to get through 3%, a lot of resistance there, came back now to 2.74, probably on its way to 2.5, 2.6, and then gradually try to see which way the economy goes. As I mentioned, we think growth is going to be better than expected over the rest of this year and into 2023. And that's going to probably mean that over time, let's say the next 12 months, that 10-year U.S. Treasury is going to get above 3, but not on this first effort.
Outlook, the market is pricing in. As always, Jay Pelosky, thank you so much.
Thank you, Marta. Great talking with you.